You just finished your monthly money ritual. You sat down, opened up your brokerage app, and watched that automatic transfer hit. $300. Maybe 500. You see it go into the S&P 500 index fund, just like every book, every podcast, and every finfluencer told you to do. You get that little hit of dopamine. You're investing, you're building wealth, you're doing what the winners do. But then you close the app and reality hits. You realize your rent is going up by $200 next month. You see that a bag of groceries that used to cost $40 is somehow $85 now. You look at the price of a modest starter home in your area and realize that even if your portfolio grows by 10% this year, the house price just grew by $50,000. Suddenly, that $500 investment feels insignificant. It feels like you're trying to put out a forest fire with a squirt gun. And you start to wonder, is this actually working? Or am I just participating in a giant psychological distraction? Look, today we're going to talk about the just invest more problem. Because here's the thing. For millions of people, investing is no longer a path to freedom. It's a Band-Aid on a broken leg. We've been sold a myth that compound interest can outrun a systemic collapse of purchasing power. Today, I want to show you the math of why just investing might actually be making you financially miserable and what you actually need to do to survive this system. My name is Mike, and I spend way too much time thinking about the gap between financial theory and the reality of your bank account. If you're someone who feels like you're doing everything right, but still falling behind, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Let's start with a term from Alice in Wonderland, the Red Queen's race. In the story, the Red Queen says, "It takes all the running you can do to keep in the same place." I see. That is the modern American economy. Common financial advice assumes a stable world. It tells you that if you invest $500 a month for 30 years at an 8% return, you'll have over $700,000. That sounds great on a spreadsheet. But here's what most people don't realize. The cost of admission to a middle-class life is compounding faster than the S&P 500 for the average worker. Let's look at some shocking statistics. According to the Economic Policy Institute, since 1979, productivity has increased by over 60%. But inflation-adjusted hourly pay has only increased by about 17%. Meanwhile, according to data from Case-Shiller, home prices in many metros have increased by over 300% in that same time frame. Here's the concrete math that the gurus won't tell you. Let's say you make $60,000 a year. You're disciplined. You save 10%. That's $6,000 a year. You put it in the market. In a good year, you make 10%. Congrats. You just made $600. But in that same year, the real inflation of things you actually need, healthcare, housing, and education, didn't go up by the government's 3% CPI. It went up by 8 or 10%. If your rent is $2,000 a month and it goes up by 10%, well, that's an extra $2,400 a year you have to pay. Do you see the problem? Your investment made you $600 richer, but your existence made you $2,400 poorer. You are investing, but your net utility is shrinking. You're running as fast as you can just to fall behind more slowly. Now, you might be thinking, but Mike, what's the alternative? If I don't invest, I'll have nothing. And you're right. You have to invest. But the just invest more mantra has become a form of financial gaslighting. When you feel stressed about money, the system tells you it's your fault. It tells you that you bought too many lattes or you didn't hustle hard enough to put an extra $100 into your Roth IRA. This creates a psychological shift called internalized scarcity. You start to view your life through a straw. You cut out the $15 dinner with friends to save for a future that is getting more expensive by the second. This is where it gets really interesting. By focusing entirely on the market, we've stopped focusing on the top line. Think of it like this. If you're in a boat with a massive hole in the hull, investing is like using a small cup to bail out the water. It's a good habit, sure. But at some point, you have to stop bailing and look at the hole. The hole is the fact that wages have decoupled from the cost of assets. The industry wants you focused on the cup. They want you debating over 0.05% expense ratios because as long as you're looking at the cup, you aren't questioning why the boat is sinking in the first place. Here's a revelation that almost nobody talks about, and it's a bit controversial. The just invest more advice actually fuels the problem for the average person. When millions of people are told, that the only way to survive is to funnel every spare cent into the stock market and real estate, what happens? We create a massive wall of forced buying. This drives up the price of those assets. This is great for the people who already own the assets, the boomers and the institutional investors. But it's a nightmare for you. This is the asset inflation trap. You are working a job to earn debt-based currency, which you then use to buy overvalued assets, just so you can hopefully sell them to someone else later for even more devalued currency. It's a game where the rules are designed to keep you on the treadmill. If the price of a house doubles, you feel wealthy because your equity went up. But if you want to move, you realize every other house also doubled. You didn't actually gain wealth. You just experienced the devaluation of your money. Now, I know what you're thinking. Mike, you're being a doomer. Investing in the S&P 500 has been the greatest wealth creator in history. Look, I agree. Mathematically, it has been, but we have to acknowledge the baseline shift. In 1980, the median home price was about 3.5 times the median household income. Today, in many areas, it's 7, 8, or 10 times. If you're trying to invest your way out of a 10 times housing to income ratio using a 10% savings rate, the math literally does not close. You could be the most disciplined investor in the world, and you will still reach age 65 with a portfolio that buys you a lifestyle significantly worse than what your parents had on a single high school graduate income. So if just invest more isn't the whole answer, what is? How do you actually beat a broken system? You have to change the game. Here is the 3-step pivot. Step 1, shift from investment returns to income velocity. In a broken system, your greatest asset isn't your brokerage account. It's your ability to generate income that isn't tied to a 3% corporate raise. If you're making $60,000, you can't invest your way to a $1 million home. You need to skill your way to $120,000. 1 hour spent learning a high-value skill, AI implementation, sales, specialized trade, often has a higher ROI than 100 hours of researching index funds. Step 2, defensive asset allocation. Stop investing in things you don't understand just because a chart went up. In an era of high asset inflation, look for real utility. Can you invest in something that lowers your cost of living permanently? Solar panels that wipe out a power bill, a multifamily property that eliminates your rent, or even just bulk buying non-perishables. These are guaranteed returns that the market can't take away from you. Step 3, recognize the financial gaslighting. Stop beating yourself up over the small stuff. If you can't afford a home right now, it's not because you bought avocado toast. It's because the monetary system expanded the money supply by 40% in 2 years, and that money went straight into housing. Once you realize the game is rigged, the stress goes away. You can stop trying to play their game and start playing yours. Here's the final truth. Investing is a tool, not a savior. If you use it as a tool to supplement a high-income, low-overhead life, it's incredibly powerful. But if you use it as a prayer to fix a life where your expenses are dictated by a broken system, you're going to be disappointed. The just invest more crowd wants you to stay quiet, stay disciplined, and keep pumping liquidity into the system. I want you to get loud, get skilled, and start building a life where you aren't dependent on a 7% return just to keep your head above water. Build your own boat. Don't just try to bail out theirs. If this resonated with you, if you felt that Red Queen frustration, let me know in the comments. Are you focusing more on your top line income this year, or are you still trying to save your way to freedom? I want to hear your strategy. Thanks for watching. Stop just investing and start building. I'll see you in the next one.